Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. China will increase tariffs levied on US goods worth $60 billion in retaliation to Trump escalating the trade tensions. The move will take effect from the 1st of June. S&P 500 slumps 2.4%, marking one of the worst trading sessions of the year. The sell-off spills over across Asia. Most of the Asian bourses start off in the red. Retail inflation rises to a 6-month high of 2.92% in the month of April. Food prices rose from unusually low levels, but core inflation fell, reflecting subdued demand. And SEBI sends HDFC Asset Management Company 2 show cause notices for delaying repayment to fixed maturity plan investors. And that tells you that the mutual fund saga is far from over. However, that's really not the focal point today. The focal point today is what's happening to the world and the trade war escalations and the impact that it is having on world markets. So China hits back and it's impacted what the Dow, the S&P or the Nasdaq have done in trade yesterday. Incidentally, tech was the hardest hit. Nasdaq fell 3.4% and that was the trend throughout the trading day. From the start of trade, Nasdaq or the tech shares were the biggest hit shares and they ended 3.5% lower. What this also did is the S&P 500 having one of its worst days in a really long time. Remember last week we were talking about how the week might turn out to be bad, and yesterday was a session wherein the day was terrible as well. But this is a reiteration of a chart that I showed yesterday. It's something that came on the Bloomberg website on Sunday. But this shows the extent of the correction that the markets are pricing in. Now, why am I repeating this 2 days on a trot? Is that if people feel that the S&P 500 has fallen quite a bit already, and therefore the falls might not be too severe, the levels on the chart indicate what eminent brokerages believe could happen to the world markets in the case of a pullback, in the case of a full-blown trade war. Remember, if we can just get the chart up again, we're talking about 2 levels out here. One is brinksmanship, which was when US and China were talking about these possibilities, but a trade war not coming in. Now we are in the midst of what seems to be a full-blown trade war, even though they have kept some dialogue or windows for dialogue open. But the second bar is the extent of fall that people believe we could see initially if indeed the trade war breaks out. So please do not think that enough of the fall has done. You don't quite know. Nobody quite knows how much further can the market all go on to. So this is spilled over to the Asian markets as well. As I said, whatever is operational today is starting off in the red. Nikkei is down about 0.7%. The SGX Nifty, which has already had a deep gash, or the Nifty, which has already had a deep gash, is already poised for some more downtick. So you will see the SGX Nifty too looking like starting off. And if there is a breach of the 100-day moving average at 11127, it might induce further selling. In all probability, we will see that. The question mark only is, if the gap doesn't get filled up, assuming we start off with a gap lower, and if the gap doesn't filled up at the 100-day moving average, then you actually have a lot of levels lower down, which the markets could go down to. So keep that at the back of your mind. The sentiment is soured in the mid caps and the small caps quite comprehensively. Those are the levels that I'm talking about, the 100-day moving average, very close to those levels. And if it starts off lower, will not go on or could go on further. Now, the sentiment in the mid caps and the small caps has soured quite significantly. The market bet was abysmal yesterday, and you can see the absence of buying in almost all companies. So, I'm just using names out here, but Delta Corp, IDFC First Bank, Dish TV, these are all examples of how the stocks corrected and stayed lower because there was hardly any buying that came into any of these names. Flows have deserted Indian markets, FIs, 1,000 crores net outflow. That, coupled with the overall sentiment, led to the rupee weakening as well, and this was the lowest level that the currency is hit since March 1st, 70.52, and the move towards safe haven currencies, exemplified by the moves that we've seen in the yen and the Swiss franc, might suggest that maybe, just maybe, there's some more weakness in the rupee as well. Let's talk about all of this with Cliff Tan. He's the East Asian head of global markets research at MUFG Bank. Joins us right now to dissect this. Cliff, good having you. Thanks so much for joining in. We've started coming off quite rapidly for the world markets now, and China retaliation would mean that we are in the midst of what is arguably looking like a full-blown trade war. What's the impact on equities at large, you reckon?
Well, I think the impact clearly is going to be negative. Though, we have quite a reasonable amount of the bad news coming into view. I'm not sure that it's completely priced yet. I mean, equities clearly were probably the asset class that were most counting on a U.S.-China trade deal. So if that's not going to be here, at least for, say, several months, I think it does require repricing.
When you say repricing, Cliff, would you reckon that we've just seen the start of what could be a substantial cut? I mean, Bank of America Merrill Lynch reports seem to suggest that the downsides for the S&P 500 alone could be substantially lower from where we are right now.
Yeah, I think 10 to 20% is not out of the question because, again, I think people were really quite confident, that we were very close to a deal a week ago. And I think, taking that out would take us back to levels, closer to actually maybe not to the lows of December, but certainly maybe as we were climbing out of that to those kinds of levels.
10 to 20% for the world markets by and large. Now,
well, I would say primarily the U.S. markets because they were the one that were the most enthusiastic about pricing in a deal.
Okay. So, Cliff, would you believe that, I mean, the last 1 month has seen the Shanghai markets or some of the other Asian markets fall off a lot more than the U.S. markets? There, the correction could be a bit more restricted if indeed the U.S. would correct about 10%?
Well, I mean, Shanghai, unfortunately, has the distinction of being, a very well-performing market this year. So that's also extremely vulnerable. I think that recovery was only partly due to the expectations of a trade deal. I mean, there were a lot of people looking for the Chinese economy to rebound. And to the extent that we get some stabilization in the numbers over the next couple of months, that could provide some support. But also, a 10% correction is probably not out of the order there as well.
Okay. Cliff, what could stop this big cracks or the possibilities of these big cracks? They have left some windows open for a dialogue. Does the sign, I mean, would the markets be happy if indeed there are some positive voices? Because hitherto what has happened is, in the build-up to this event, there's a lot of positive talk which only resulted in a negative outcome. Would the markets be happy with some positive commentary from either side, or will the markets need to see pull back of these tariffs for them to be convinced that the trade war is not well and truly here?
I think the markets, if not already, should be heavily discounting any talk right now because the talk, the positive soundings, the tweets and so on, have not proved reliable. And if you were a serious investor, I think you want to sort of stop paying too much attention to this. For us, we have consistently been very skeptical about a deal. I mean, we've talked about what we called DINO, which is a deal in name only, thinking that if we were going to get a rapid deal, it would be kind of vapid without much substance in it. I mean, I've always believed that serious investors should really look at the actual content of a deal. And what we saw last week was that when push came to shove and we got to really serious issues like enforcement, like the tariff levels, like the kind of commitments that the U.S. wanted from China in IPR type issues, that we couldn't do it. And so that's why I don't expect a deal anytime soon, a really substantive deal, and I think we're sort of in a stalemate situation at present.
Okay. Cliff, one last question. If you look at India closely, when the first inklings of this trade war came to being, a lot of people said that India could actually stand out because it doesn't get too impacted on a global trade front. Would you reckon that would be the case if indeed the local event, which is the elections, passes off smoothly without much hiccups?
India could be defensive, yes. So I think there is some truth in that. But, I think what people need to worry about is, right now, I would say that we're kind of in the territory in which, of which the trade war could shave anywhere from 0.5 to 1% off of Chinese growth. And on the U.S. side, say 0.3 to 0.6 percentage points off of growth. If we move on to the next level of escalation, the remaining $300 billion or so of U.S. imports from China, and they also get 25%, the trade effects could really, the growth effects rather, could double. And so what India needs to be concerned about is actually more about, the return of a global recession. A global recession would not be good for any market, including India's.
Well, that's well put. Okay, Cliff Tan, appreciate you joining in and giving us your thoughts. Thanks much for taking the time out.
Always a pleasure. Thank you.
That's Cliff Tan of MUFG Bank. I think 2 or 3 key points. One is the global GDP cool-off will not augur well for any market, so you can appreciate that. 2, I think one big factor that maybe people are not quite considering right now, that money started coming into India in a big way. Yes, on political stability assumptions, but also because the world wasn't looking an unhappy place. Now, if the world is starting looking a bit worried, the FI outflows that we're seeing, will they hasten? And if that were to happen, what will happen to the currency and what will happen to the equity markets is another kettle of fish altogether. So keep that at the back of your mind. Just very quickly, before we get to first word, the 2 or 3 things that I believe one should monitor back home in India. I was talking about the currency and how that has weakened and how flows are looking weak. I think it's very important for 2 things to happen today. One, for earnings to come out and come out well. Hitherto, we've seen consumption names not quite performing well. Today is a big day. There is Nestle, there is Pidilite, and there is Westlife. All of them connected to consumption, and you need at least a Pidilite and maybe even a Westlife, because Jubilant FoodWorks numbers come out in the next couple of days, and these are trader-friendly stocks, to come out with numbers which are par for the course and not worse off. The murmurs on the street are that the numbers will probably be below estimates. The street desperately needs these numbers to be okay. There are some financial names as well, Edelweiss, IIFL, Union Bank, etc., which will be important. But I dare say the consumption names today would be of crucial importance. And just very quickly, the 2 or 3 names that I would watch out for at 9 a.m. today. So the markets would start off lower. So an optically good Q4, but slightly below estimates. SRF. Let's wait and watch what the chemical business growth does for that one. It came back after a lackluster Q3, so let's wait and watch for that. Whether a strong quarter for these names tends to bring about anything on those stocks, whether the MSCI inclusion does anything special for ICICI Lombard, and whether the demerger announcement and clarity on the demerger from IIFL Holdings does anything to that stock. So 3 or 4 names, all of which have some triggers to themselves, just that the market will probably weigh in on them. Let's wait and watch what happens there. But as I said, on first word, let's tell you what's lined up today. Darshan Johnson to take a look at the 4th quarter earnings season and how it has shaped up thus far. Automakers want a tax break to revive demand in the sector. Yatin Mota will join us with SIAM's proposal. Somit then Johnson to take a look at the valuation of Reliance InvIT to see if the math adds up. And then Darshan comes back with the latest MSCI rejig. What is in and what is out and what is important to note. Earnings, the most important one, halfway through the March quarter earnings season, and you'll be wondering what has happened thus far. Well, the performance has been quite mediocre so far. Very few Nifty companies have managed to report strong numbers as the slowing demand in the larger economy starts reflecting on the numbers. Darshan is standing by with a scorecard. Darshan, I presume we're talking about the Nifty today and then the other components tomorrow or day after.
Yeah, so we'll talk about the mid-caps companies which are outperformed probably tomorrow. But today's the Nifty, almost we are halfway there. 27 companies of the Nifty have reported numbers. It's been mediocre. Even if the numbers are mediocre, I think the commentary was rather weak. So out of the 27 that have come out, you can clearly see majority of them have come out with numbers were in line, 4 strong and 6 weak. So that's the trend that we're seeing. If you take a look at the past trends, clearly you can see that the number of earnings that have met estimates have gone up significantly, and the number of strong earnings compared to what it was 11 last time around compared to just 4 right now, and the number of weak earnings have pretty much stayed the same. So the number of strong earnings are getting converted into inline, and even there, even if the numbers are strong, the commentary is not good at this point. So that's the broad trend that we're looking at. In terms of how the market has the numbers have come out. So 4 companies which have come out with strong numbers. It was HDFC, Tata Steel, Ultratech and Bharti Airtel came out with strong numbers. But despite that, a couple of these counters have corrected. A lot of these auto names, Eicher Motors, Maruti Suzuki, Yes Bank, Indiabulls Housing Finance on the financial side came out with weak set of numbers. On the the consumption, while it has been stable with weak commentary, Asian Paints managed to disappoint as far as earnings are concerned. Now, if you look at how the EPS estimates have actually managed to move up, you can clearly see it's been stable. So at the start of the quarter on 1st Jan, it was 137 what we were anticipated. 15th Feb is when the third quarter season finally ended. It was at that level, and April 11th is when the first Nifty company, that was Infosys, came out with numbers. It was 141. So pretty much at this point of time, it's managing to stay stable. So as far as earnings is concerned, it's been stable. So out of the 27 companies that have come out, the estimate was 85.9. It's come in at close to 84. So it's broadly in line. No major surprises. Like last time we had Tata Motors, which totally skewed it. The quarter before we had SBI, which totally skewed it. So at this point of time, no major surprises. The big surprise obviously was Yes Bank, but the weightage is small, so that actually didn't impact the Nifty number so much.
Yeah, well, let's wait for the end of this as well. But Darshan, if we try to dissect this sectorally, what are the major trends and factors at play for the various sectors? Yeah,
so we will talk about the companies that came out with numbers. So I think let's start with the auto pack, because that clearly is the big disappointment that we've seen. It's the 5th quarter in a row that we haven't seen any kind of strong numbers. It's either been weak or in line. Eicher Motors was down 7%. Demand was weak and inability to pass on the cost increases, especially the ABS, that impacted the company. Maruti, higher discounts, capacity ramp up is happening. That's where the capex is going. Volumes were lower. Guidance not the best, so that was impacted. And Hero Moto came out with numbers that were in line with estimate. No doubt there were production cuts that were taken to correct the inventory that was there, and higher promoter spends this time around. So auto as a pack was weak this time. Cement, the only company on the Nifty, that is UltraTech Cement, came out with strong numbers. Pan-India players have not done well. So the other companies have done well, be it a Dalmia or a Kakatiya Cement from the smaller one, or an Orient Cement. UltraTech did extremely well. I think the big casualty was AC, which disappointed because of capacity issue. Better than expected cost efficiencies aided UltraTech. The next one is the construction one. While numbers were in line, operationally it was weak because the largest segment, infrastructure, that margins disappointed. They maintained the guidance for FY20, which the analyst community thinks is rather is not very encouraging, because they don't see any kind of growth coming in. So L&T this time around operationally weak, but in line set of numbers. On the consumption pack, yes, there was clear amount of slowdown that is seen. Britannia saw higher cost of new launches that impacted the company's numbers, that corrected significantly. Titan was a big exception because the jewelry business did well to offset the weakness in the watches and the other division and the eyewear division. HUL, home care sale was strong, personal care was weak, but overall in line set of numbers. ITC operationally was weak, but cigarette probably did well. And Asian Paints, volume growth was clearly there, but the margin was a big miss this time, and was one of the weak earnings on the consumption side. The other one that we want to talk about is the oil and gas, and that only Reliance has come in line set of numbers. Petchem EBIT declines for the first time in 8 quarters. Jio was also very, very average, so in line set of numbers for Reliance Industries. Some of the other sectors that we want to talk about, obviously the banking sector, steady set of earnings except for a Yes Bank, which disappointed significantly. Axis was a weak deposit growth, but slippages, asset quality was better. HDFC, always stable set of earnings that came in. ICICI Bank, the final number was lower because of higher provisioning and slippages, and Kotak was in line. The main bank did well, but the subsidiaries did manage to underperform. Some of the other numbers, Yes Bank, obviously the big loss that came in the counter corrected. SBI was decent this time around. Asset quality was decent because of lower slippages, and Indiabulls Housing Finance, weak disbursement, asset quality also went down. So not the best of quarters for them. No fireworks in the IT space. Most of them came out with inline set of numbers. The guidance was also rather stable, so it's rather stable on the IT pack. The other couple of sectors that we want to talk about basically deal with the metal space. Yes, Tata Steel did well, higher growth in the European division. But now it has problems of its own. And Vedanta, guidance was conservative amid debt reduction, but for Vedanta, the corporate governance issue in terms of the Anglo-American still remains an overhang. And finally, on the telecom side, Airtel, the mobile revenue positive for the first time since Jio, so Airtel did well. Infratel obviously not doing well. Biggest revenue drop in nearly 6 years. The tendency continues to decline because it's becoming a shrinking market now.
Okay, Darshan, thanks so much for putting that into perspective. So that's Q4 thus far. most expectations were, I think Manish Sontalia's expectation, for example, was that save for banking will have a near zero growth for earnings by and large, at least on their coverage universe, turning out to be a grim Q4. Autos, one reason maybe, and which are already grappling with the slowdown in demand, are afraid that things will only get worse with more stringent emission norms and safety standards. To counter the effect, Society of Indian Automobile Manufacturers are asking for a tax cut. Yatin Mota is here to tell us about SIAM's proposal and the potential impact, if any. Yatin, good morning.
Good morning, Neeraj. And this is not the first time the automobile has been asking about tax cuts. We have seen a tax cut way back in 2014 and 2009, around that election period, wherein the government of India did some adjustments to the excise duty. The current GST rate on automobiles and auto spare parts is nearly 28%. However, SIAM is demanding that this be reduced by at least 10% to a level of 18%, which will help not only the recovery of the auto sector, but also help the government of India to generate better jobs, and also given the fact that auto sector contributes to nearly 7.5% of India's GDP, we could see some bit of recovery in the economy as well. So that is what SIAM has been arguing, that a number of safety measures as well as the emission norms which kick in, which is BS6, would push up car prices as well as automobile prices, because of which there needs to be some bit of tax break. Previously, Neeraj, we have seen that whenever there is a tax cut, there has been a boost to the demand, to the tune of 15-20% of total volumes. So previous instances have shown that whenever there is a tax cut, we have seen some bit of improvement in the automobile demand. Also, if you look at the cost of BS6, according to a Nomura estimate, the two-wheeler prices will go up by at least 10%. Diesel passenger vehicles as well as light commercial vehicles, there the price is expected to rise by nearly 10 to 15%. In fact, when I was speaking to Honda Motors, one of the largest two-wheeler maker after Hero MotoCorp and Bajaj Auto, they were talking about a 15 to 20% price hike rate. There will be effect of 35,000 crores, but you will also gain by higher volumes by around 5,000 crores. So net of net, the government of India as a percentage of GDP will have to look at a 0.14% according to Nomura, the kind of deficit that we are talking about. And finally, how will a tax cut really help? Because that is something that not a lot of analysts have spoken about. Nomura believes that if there is a GST cut of 10%, we could see the operating profit of most auto companies rise by 15% from the current FY20 and FY21 estimates. And similar is the case with the auto volumes. That could be higher by about 10% to the current estimate. So Nomura does believe that there is a significant amount of upside in auto volumes and auto earnings once such a kind of stimulus is given in the marketplace. Of course, you can read the entire article and industry views on our website bloombergquint.com. The article is already up. The headline is Auto Industry Seeks a 10% GST rate cut as a option to counter the effect of BS6.
Okay, Yatin, thanks so much for putting that into perspective. And as Yatin said, do log on to the website and try and read more about this. The next piece on First Word is on Reliance Industries, which has transferred its tower and fiber assets to a special purpose vehicle, which in turn will be managed by an InvIT. Now, questions are being raised on the valuation, given that there is a markup of nearly 80,000 crores. Sumit Sarkar is here for more on this. Sumit, let's start with what's been transferred to this SPV, and did the parent get anything after the transfer?
Well, yes, they have transferred. The parent did get something because of this transfer. So RL has transferred its tower and fiber assets to a special purpose vehicle, which will be managed by the InvIT. Now, RL had invested close to 1,25,000 crore rupees in these assets, but now they are valuing these assets at close to 2,03,000 crore rupees. And this difference in valuation, that is close to 78,000 crore rupees, will be was settled by issuing preference shares to Reliance Industries. Now, how was this valuation derived? Well, according to the company, the valuation was based on studies done by international internationally reputed expert firms. Now, RL did not give any details on who has done this external valuations and how the number was arrived. This was the only detail that Reliance Industries gave in their presentation. Now, according to our calculations, based on the industry benchmark, this valuation seems to be on a higher side, given the fact that not all its assets at this moment are ready, and it will be difficult for the InvIT to find an external user for this assets. Now, for the fiber asset, if you see, there is no specific benchmark, as there are no listed companies and there have not been any recent deals in the recent past. But according to industry experts, the replacement cost for 1 kilometer of fiber is close to 10 lakh rupees. Now, based on that, Reliance Industries 11 lakh kilometers of fiber could fetch a valuation of close to only 1.1 lakh crore rupees. But the catch here is that not all its assets are ready. Only 7 lakh kilometer of fiber is ready of the total 11 lakh kilometer. Now, for the tower asset, if you see, Bharti Infratel's per tower enterprise value is close to 50 lakh rupees. Now, and back in 2017, Vodafone and Idea had transferred the tower assets to ATC. Now, if you see, the deal value here is much lower, but that is because of the lower tenancy ratio that Vodafone and Idea towers had. Now, this supports the fact that the valuation of a tower company is directly proportional to the tenancy ratio. Higher the tenancy ratio, higher is the valuation. Now, based on these valuation, Reliance Industries 1.75 lakh tower assets could fetch a valuation of close to 43,000 crore rupees. Now, though the derived valuation of this tower asset is higher than what the company has valued it at, but remember the fact that the company would find it difficult to find an external user, and it might only end up with only one user, that would be Reliance Jio for this tower assets. And again, not all its tower assets are ready here. Now, both the SPs are yet to file the valuation report with the Register of Companies, and the company is in process of preparing the prospectus for InvIT. Hopefully, the InvIT will give us more details on the valuations, the revenue and the cash flow that they're expecting from the fiber and the tower assets. Now, we also spoke to a couple of accounting experts to get in more details on this valuation, and to catch up on that, do log into our website, that is www.bloombergquint.com, where you will also get more details on how the valuation was derived for these assets.
Thanks so much for that, Sumit. So that's Reliance InvIT. And the last piece on First Word today is the changes that MSCI has announced. So the composition of its indices that will be effective from the end of this month. The healthcare counter has made way for an insurance player in the Global Standard Index, while there are a slew of changes in the small and the mid-cap space. Darshan Mehta is standing by to sum up the changes and the impact, if any, on each of these counters. Darshan.
Yeah, so basically two changes in the large cap index. ICICI Lombard General Insurance comes in and Cadila Healthcare goes out. So pretty much in line. The earlier notes that the analysts had anticipated did include that, you know, some of the other insurance company like an SBI Life or an ICICI Pru Life probably will come in. That didn't come in. The general consensus was Cadila probably will go out, Tata Power will go out. But what has happened is there are just two changes. ICICI Lombard in and Cadila Healthcare out. What kind of fund flows we can see it? The weight that Morgan Stanley anticipates ICICI Lombard to have on the MSCI will be 0.36%, in which they believe $115 million of inflow will come in. For Cadila Healthcare, they believe that there could be a potential outflow of $62 million, and this will happen till the time the rejig happens, that is the end of the month. So till end of the month, there will be $115 million of buying in ICICI Lombard and $62 million of selling in Cadila Healthcare. Now, the other part is the small cap index, in which there are almost 12 additions that have come in, counters like an Aavas Financials, AstraZeneca, BML, Chalet is a recent addition that came in, that comes out, and some of the companies that have been deleted include CSC Ventures, even Spencer Retails has gone out, DCM Shriram, ISJEC, Arcom. So this all depends on the weightages of the company. So 12 companies have come out and come into the MSCI, and 10 companies have gone out, and the impact probably will be similar to all these companies also. The other important factor is that India probably may lose weight. Now, we don't know exactly what the weight loss may be, but there are three things that have happened. First of all, there is an inclusion of the Saudi Arabian index with a weight of 1.42%. There is an inclusion of Argentina to the tune of 0.26%, and increase in China A share. This is the first step, and two more times they will increase the weight of China A shares. So that will come to 1.76%. Because of the addition that will come in, the India's weight in the MSCI probably will shrink, and that is why there could be more potential selling in the Indian markets.
Well, let's wait and watch what happens here to the markets at large and to some of these specific pockets. I dare say the market levels show that we don't need And MSCI changed to tell us that there is going to be some selling, but this will be added pressure. That's all that we have on First Word today, though. We'll try and talk about the pressure on the markets with UR Bhatt a bit later on. He joins in at 9:15 to talk about that. We decode March quarter earnings with Alok Tandon of Inox Leisure and George Alexander Muthoot of Muthoot Finance. But after this break, a full tilt towards the day's trade.